All right, well, let's take a look at the markets this week. They were down again this week, and some of the lines that I had laid out last week that I thought, boy, if we start crossing these lines, it may spell trouble for the markets. And I've added some trend lines, also added some moving averages that might help explain what's going on. So let's just go to the start with the Dow Jones today. Good portion of the day, and this is a weekly chart, so what you're seeing here, we had this potential. Let me go back to daily just briefly. We had this potential bull flag type of look here, but we've broken through it. So from my perspective, that's not valid anymore. I had laid out the 34,400 on the Dow is kind of an area that I was watching because concerned that if we get below that, then we start to get into kind of a danger zone, I guess might be a good way to put it. We're already operating. This is the 18 in the yellow here, moving average, simple moving average, and this is the 40 simple moving average. We're already below that. We're looking down here at 33,682. We filled a gap here. We've got another one a little bit lower. I was happy from a bullish perspective that this kind of did a U-turn today and finished above the 34.4 area. There's nothing magic about that. It's just kind of looking at the chart, it looked like an area that might be useful, and maybe it's even down a little bit more. Somewhere around in this area for support. But that's the Dow, and I had mentioned some of these areas. I believe last week we look at the SPY. One of the things I did add to the SPY here was the trend line going up. We kind of broke through it briefly, but we're back above it at the close, and we still have some trading going on post market. And then we look at the weekly, you can see we've had two relatively large bars. This is, I wouldn't call it a doji, but you have kind of equal wicks on both sides. But, for the week. And, you kind of like to see it regain this 437 area and this kind of greenish area that I have mapped out. And we also look at the Qs, and let's go back to the SPY for just a second because I want to mention this trend line here. It went down and it hit this moving average here, the 18 simple moving average, and also this trend line, and bounced off of it. Excuse me. So that is something significant. And then the Qs did in essence the same thing for these are the weekly data again, and came down to hit the 18-day and then recovered this 357 that I had mentioned last week for the Qs. And then we look at IWM, kind of did the same thing, went down and hit this trend line. This is the Russell weekly, and it came down and then made its way back up. And so, for today, going back to daily data, I was getting a little worried down here, but it just kind of sat. If we go to a smaller time frame this morning, we had this kind of gap down thing, but immediately recovered it after the open. Immediately recovered it, and then just kind of sat in this area. So this was just kind of a quick trip down the elevator, and then immediately back up in the next within the next 5 minutes. And I think if we even look at the minute, you can see, the open gap, made our way back up almost immediately. So anyway, that it didn't spend much time below 3 minutes below the line that I had, the 184-ish area, and then wound up recovering also this trend line, this support area. So there was a lot of kind of good things there, and I kind of had my line in the sand down here, 160. If things had gotten even uglier, this kind of 164 to 172 area, that's pretty wide. Probably could be refined a little bit. So I was happy to see some of these get recovered, and the trend line still be pretty much in place for all of the markets. Not to the point where I'm panicked. I'd like to see a little bit more recovery, but this wasn't unexpected. We expect to pull back after a big run up like we had here, going from 169 up to almost 200 on the IWM on the Russell. Taking a look at the yield, this was interesting. Came all the way up, and for the week, these are weekly data again. Going back to October of last year, we came up and hit this 4.1/3%, and then it backed off as the day went on. And if you look at the daily data, you can kind of see that it backed off. Now, David Hunter, who I'll talk about at the end, and versus Peter Schiff, kind of have two different views of where we're going here in the markets, and we'll talk about that along with inflation. But we've got the dollar that's run up. It's run into a bit of a brick wall here, some resistance at 103.425, the DXY, and I think a little clearer what's going on here when we use the weekly data, kind of see what's happening. We've kind of stair-stepped up the last 5 weeks, and hitting here, expectation again is the dollar start to turn back and become weaker on the part of David Hunter. And then crude, this is where we begin to see some of the separation and some of the philosophies that are out here. This being that I think Peter Schiff's expectation is it will break this and continue on up into, at least 100. And David Hunter is expecting this to go back down. But again, I'll talk about that at the end. The VIX wound up down for the day, but for the most of the day, the VIX was up. So the volatility index was, running hard. And so that's a look at the markets. I also want to make note of anytime you get a downturn, you've got a bunch of stocks now under their 200-day, more than 50% back down to 44. Call it a correction. We like to see this eventually make its way back up. Now, investor sentiment, it really changed this week, and I think it's indicative of the kind of last 2 to 3 weeks that we've had with the markets heading down. We have the bullish sentiment. It went from, in 1 week, and remember, these come out on Wednesday night, went from 44%, or almost 45, down to 30, roughly 36%, and now we're starting to see people get a little bit more bearish. So we'll kind of keep track of this. And then the fear and greed index. This is interesting today. I kind of kept an eye on it. We went from extreme greed not long ago, probably 3 weeks ago, all the way down. We made our way into the greed this week. Now it says it's kind of low neutral, but it was in fear earlier this morning, roughly, I don't know if it was like 38 or something like that. So it ended up neutral for the day as the markets recovered a little bit. And taking a look at the economic calendar, we didn't really have anything. And if you look, even next week, we don't have a ton of things going on. So I think a lot of people are expecting that the markets will probably stay in a range, that it won't move a whole heck of a lot. But if we look at what happened this week, we had retail sales came out stronger than expected. New York manufacturing index, again, down. It's been running that. It made a little bit of a recover, or the expectation was it would only down one after a positive, which they hadn't had for a while, in New York manufacturing index. And just kind of go back and look at this. We've had a couple months, but for the most part, it's not been performing well. And we also had building permits. Well, we had the mortgage rate has been inching up, and people are talking about 8%, type of rate on a 30-year as they keep going up. And then we have building permits at a little bit lower than the expectation, not a ton. Housing starts pretty much in line, a little above. And then we had the FOMC minutes, but there really wasn't a ton in there. But there was pretty much agreement that they needed to raise the federal funds rate. And I think that a lot of people are now starting to think that we'll get the 0.25%, and we'll see what that looks like on next week. I'll be sure to bring in what the guess is. The expectation is for increasing the federal funds rate. And anything can happen in between. We also had yesterday, we had the Philly manufacturing index came in a little bit stronger than expected, and initial jobless claims were at 239. Now, I didn't put this in here, but the GDP expectation is going to be a 5% growth. So when you spend all that government money, you get some growth, and not necessarily a good way. And so looking forward to next week, we got a few Fed members speaking. And then Wednesday, we obviously have the mortgage rate. And we get PMI come in. Now, manufacturing's been coming in under 50 pretty regularly. I'm still expecting that the services would kind of tick down. But we really haven't seen it. It's been very steady around this number. We go back, it's been, if anything, it's actually gone up, the services component. And so it's something to keep an eye on. I don't think any of these things are real market movers. And Wednesday we have the new home sales. Again, not a big market mover. We're expecting durable goods orders to go down. Initial jobless claims, expect those to go up, but they've just kind of been holding steady here. And then Friday we have the Michigan consumer sentiment, and Powell will be speaking. They're at Jackson Hole on Wednesday next week, and Powell usually makes some comments after they meet at Jackson Hole. And so that's a look at the economic calendar. If we look at the Truflation, which I like to look at, I think it's a good lead-in. We have the inflation rate got to as low as 2.08 on Truflation. And this is not a government figure. This is outside figure, but I'm finding it to be not only interesting, but probably more accurate, more updated. Housing has been problematic. It's up almost 1% from a week ago. Transportation is costs are up by almost 1% also from a week ago, and those are kind of the two big ones, because housing's getting more expensive as interest rates go up. People are going to rent out their homes or apartment. Everything costs more. So this leads to kind of my final comment. I follow Peter Schiff for a number of years, and then David Hunter for maybe a couple years now. Some of the forecasts he had, I didn't pay that much attention to him until he made kind of the big forecast, but I found that his forecasts were fairly accurate, and I've got an episode on that I did a while ago. I got quite a bit of attention, but the two people that I'm really following that I consider to be contrarian, I would say maybe Peter Schiff is more an economic contrarian, and David Hunter more around what the markets are going to do. He would probably disagree with me, but this is my show. But the expectation is on David Hunter's part, and let's just go back to the crude oil. The expectation on Peter Schiff's part is that we're going to get lots of inflation. It's going to continue to go up from here. Maybe, not necessarily in a straight line, but it will go up. David Hunter expectation is that things like crude oil will start to go down, housing will start to go down, and that that we will eventually, because of the errors of the Fed, will have a lot of these things start to roll over and really kill off the economy, and leading to first of all, a melt up, which I've talked about a number of times, going back to the SPY, not only going to 480 on the 4,400 on the S&P, but to 6,000. So I don't know where the 4,400 number came from, but this running all the way up to 6,000, more on looking at the SPY here, would kind of translate, a 0.1 multiplier on the SPX. But 436.50 where we stand, we're close to the all-time highs. That would play into the melt up. But Peter Schiff he has never really said what his numbers are, but his expectation is that the market will continue to make its way down. So we have kind of two different philosophies going at each other at this juncture, and the expectation of what happens next. We'll have David Hunter with his deflationary forecast ultimately, and then you have Peter Schiff with his inflationary forecast for the future. And I would say David Hunter, definitely believes that we're going to get huge inflation, but he's also believes that we're going to get this big bust. If 6,000, let's say, is what it makes it to, or on the SPY, let's say around 600. He's talking about an 80% drop, which would put us all the way down at 120. I was looking at the numbers from 2008 and from the dot-com bust, and I think around the dot-com bust it was around 50%, and then in 2008 during the great financial crisis it was down 56 to 58%, somewhere in there. And so this will be something that, if David Hunter's forecast comes through, that would be something bigger, and then his expectation is after that we're going to get all kinds of inflation and other bad things that are going to happen as we approach or go into 2030. Hopefully they don't happen, but I'm pessimistic. Both Peter Schiff and David Hunter I think their expectations are big drops in the market ultimately. How we get there, um, Peter Schiff, I would say, is more from an inflation standpoint, and at least immediately in the intermediate term, David Hunter believes that with the bus we're going to have deflation for a while, and that our markets will be in a bear market taking us all the way somewhere. If he says 80%, that's going to put about approximately 120. So anyway, that's that. I just wanted to kind of talk about two different expectations. We'll see how it plays out. And I think, as David Hunter would say, we watch and learn and see which of these philosophies play out. Peter Schiff has been calling for the markets to drop for a long period of time, but he's looking at the market expectations as opposed to, or excuse me, the economic expectations of the errors that have been made. If there's a Venn diagram, I think there's some things these guys would agree on. They may object to that, but I think the end game, they both see bad things coming next year or maybe even late this year. So anyway, that's what I wanted to cover in this episode. And remember, there's always a better way.